In this video, I'm going to talk about how to go from $0 to $100,000. Or if you're not using US dollars, how to go from $0 to 100,000. Insert your currency: euros, yen, pound sterling. There are multiple ways to invest and make money. I'm going to be focused in this video on index funds. I'll explain what index funds are later in this video. Some of you probably want me to immediately go into how you can achieve $100,000 from zero. I want to be clear, this video will not be talking about how to get rich quick. This video will not be talking about how to get rich by buying lottery tickets. Investing in the stock market is a long-term investment strategy. It may take you 5 years, 8 years, 20 years, perhaps even 30 years to go from $0 to $100,000. If you are someone who has no current investments and is wondering how to secure your financial future, stick around. Briefly, I want to explain why sometimes I use AI for the audio. My current setup doesn't always allow for great audio. So it's either don't make the video and hope that I'll make it one day, which day may never come, or create the video now with AI. My lighting and other physical setups also are less than ideal. I may include an image at the end so that you understand why this isn't a video of my talking head. Many people are afraid of the stock market because they don't understand it. I was one of those people as well. So let's take a look at the US stock market, because one should not invest in anything one doesn't understand. When we pull up a historical chart of the US stock market, the graph usually shows the Dow Jones Industrial Average. The Dow Jones Industrial Average is one way of measuring the stock market's overall health. It includes the prices of 30 of the most actively traded stocks. When the Dow goes up, it is considered bullish, and most stocks usually do well. When the Dow falls, it is bearish, and most stocks typically lose money. Looking at this chart, we see that the Dow has been going up if one considers the overall history. As I have indicated before in a previous video, the link will be provided in the description. We can also see periods of flat growth, and also significant drops and dips. So, even though the overall trend, if you're a long-term investor, the Dow shows an upward trend, we cannot say that there is no risk. There is a risk that the market will crash and never recover. However, if you believe in the continued upward trend of the US stock market, then there is a good chance that the long-term average of gains will continue to be north of 7 or 8% per year, on average, adjusted for inflation. As I explained, I will be focused on index funds in this video. An index fund is a type of mutual fund or exchange-traded fund that seeks to track the returns of a market index. The biggest difference between index funds and actively managed mutual funds is that index funds invest in a specific list of securities, such as stocks of S&P 500 listed companies only, while active mutual funds invest in a changing list of securities, chosen by an investment manager. Over a long enough period, investors might have a better shot at achieving higher returns with an index fund. Index funds have a much lower average management fee, also known as an expense ratio. Index funds management fees averages 0.05% compared to mutual funds management fees, which average 0.44%. I will be looking at some of the index funds and ETFs, exchange-traded fund, in my own portfolio. First, let's take a look at VTSAX. Created in 2000, the Vanguard Total Stock Market Index Fund is designed to provide investors with exposure to the entire U.S. equity market, including small, mid, and large-cap growth and value stocks. Since its inception in November of 2000, VTSAX has increased in value by 435.12%. For the past 12 months, the return has been 18.92%. The expense ratio is 0.04%. The VTSAX has 3,859 stocks in its portfolio. So how do you get from 0 to 100,000? Let's do some calculations. Looking at just one index fund for now, VTSAX. The current price is $109 per share. Let's take a look at the price for different time periods. This particular index fund requires an initial investment of $3,000. If you don't have that much to invest at this point, we'll take a look later at ETFs, which require much less to start. Okay, so let's just go back 10 years. As shown from inception November 2000, the return is 435.12%. The 10-year return is 218.33%. So let's say that in July 2013, when the price of VTSAX was 42.51, we put in 3,000. Then in July 2014, when the price was 48.55, we put in another 3,000. Then in July 2015, when the price was 52.96, we put in another 3,000. That would give us 189 shares, as in 2013. 3,000 bought us 70.57 shares. 2014 bought us 61.79 shares, and 2015 bought us 56.64 shares. The current price of VTSAX is 109. 109 times 189 equals 20,601. So if we had put in a total of 9,000 by 2015, not accounting for compound interest, that 9,000 would now have grown to $20,601. Of course, with compound interest, that amount could be even higher. Now, if you were able to contribute just 3,000 each year from 2013 to 2021 for a total investment of 27,000, 9 years, the number of shares you would have would be 440.3. This example would put in 3,000 each year at the end of July. Of course, you are not restricted to any date, nor are you restricted to only put in 3,000. After the initial 3,000 investment, you are able to put in less than that or more. If you were to invest 3,000 from 2013 each year until 2021, and you were to sell today at 109 per share, your 440.3 shares would come to $47,992.70. That's about 180% gain. So, for simplicity, I am not calculating in how much more you would have if compound interest were in the mix. If you were able to increase your investment for a few years from 3,000 to 5,000, increasing your investment in 9 years to 35,000, and if you were to sell those shares today at 109 per share, you would have $58,703.04, a 165% gain. This, again, is not factoring in compound interest. So, you see, the numbers add up quickly. Therefore, getting to 100,000 is actually achievable. It is achievable if you understand that investing in the stock market may take time. As I explained earlier, it may take 5 years, 8 years, 10 years, 20 years. But as the previous examples showed, if you are able to even just invest 3,000 a year in just one index fund in about 10 years' time, your money potentially will grow by over 200%. Let's do another calculation. If you're able to invest $3,500 today and add $5,705 every year thereafter for 10 years, at an annual return of 10%, you would have $100,000. Okay, let's take a look at ETFs, exchange-traded funds. Unlike the initial investment minimum for an index fund that might be $3,000, you can buy an ETF for as little as $1. Some brokerages might even allow you to buy fractions of an ETF. All right, we're going to be comparing two ETFs, Schwab's SCHD and Vanguard's High Dividend Yield Index VYM. Both of these ETFs are dividend-paying. SCHD is Schwab's ETF that invests in U.S. dividend stocks, tracking the total return of the Dow Jones U.S. 100 Dividend Index. VYM invests in high-yield dividend stocks and tracks the FTSE High Dividend Yield Index. Both ETFs have nearly $50 billion in assets under management. They also share identical expense ratios of 0.06%. This is an attractive expense ratio.
Okay, so first let's take a look at Schwab. But first I want to apologize in advance if there are audio issues. I was, if you couldn't tell, using an AI generator earlier, but it's really difficult to do voiceovers and figure out what I was looking at or trying to say earlier when the screen for the preview is really tiny and you're looking at really small fonts. Okay, so the current price for one share of SCHD is $75.08. It has a total holdings of 104 companies, stocks. Let's take a look at its performance. So since inception, which was 2011, the performance, the gain or return is about 13%. Let's take a look at 3-year. The return is about 16%. 1 year, 5%. Of course, we know what happened during the pandemic. Let's take a look at VYM. I apologize, my fan's going off. Okay, inception for VYM was November of 2006. Since inception, the return is about 8%. Three-year return about 14%, 1 year 8%. Okay, let's take a look at another ETF. This is Vanguard's VUG, Vanguard Growth ETF. The expense ratio is 0.04%. The current price is 287. Year-to-date returns 35%. Inception date 2004. Let's take a look at its performance. Since inception, 10.5%. 3-year, 12.6%. 1 year, 28%. Year-to-date, over 33%. That's really high. Let's take a look at why it's so high. Sorry, my fan's going off. Okay, I probably have to apologize a bunch of times for audio issues. So now probably you can appreciate why I use AI sometimes. Okay, let's try to figure out why the return is so high. I mean, it's great. So we're looking at its portfolio composition. Technology is 52%. Okay, let's look at its top holdings. Almost 14% Apple, 12% Microsoft, Amazon, Nvidia. Here are some of the others. We're going to take a look at page 2. MasterCard, Home Depot, Costco, McDonald's, Netflix. Let's look at page 3.
Advanced Micro Devices, Texas Instruments, Disney, Nike, Boeing, Intuit. Yeah. Okay, I think the year-to-date return of 35% is hella wonderful. Awesome, yes, but if we want to be cautious or come back down to earth, I think the more realistic expectation should be in the range of 10 to 12% in the long term. All right. That was a little glimpse into some of the holdings in my portfolio. As I explained, this isn't a get-rich-quick investment strategy. It probably would be called boring by some. We are talking about 7 to 10% gains on average over a long period of time. Are there faster ways? Sure. Every other day I am hearing about people making millions or hundreds of thousands making content on TikTok or YouTube. Or someone buying a memes of 6529 for 0.067 ETH or 0.065 ETH and flipping it an hour later for 1.2 ETH. Or the guy who was gifted a Moonbirds NFT and sold it a day later for $500,000. Or someone who bought Bitcoin back when it was $800. Or someone who bought a house for $400,000 and flipped it for $1 million. If you're one of those people, awesome. I wish I were one of you. I wish I was a crypto bro and someone gifted me a Moonbird or a few crypto punks. But for the moment, I ain't one of you. So, I'll just be over here doing my boring index funds. But if anyone wants to gift me a CryptoPunk, I'll put my ETH address below in the description. I know my examples earlier were for annual investments of $3,000 or $5,000, and some of you may not have that much to spare annually. I get that. There were many, many years when I didn't have much to spare after paying for food, rent, gas, etc. But there were also years when I went skiing out of town, which meant flights and hotel fees for weeks and a month. When I bought things I didn't need or ate out more than I should have. If you don't have the funds now to invest, I hope this video educated you a little on how the stock market works, so that if, in the future, you are looking to invest, you will have the knowledge to decide whether you want to put your funds into index funds.